Our next speaker is the CEO and founder at STASIS and the managing director at Continuum Fund. He is also the official contributor to the digital assets legal framework for several countries like Malta and Cyprus. So continuing with the theme of stablecoins, here to present to you on the role of stablecoins in modernizing financial regulation, please put your hands together and give a warm welcome to Gregory Klumov.
Good afternoon. Let me start by asking, who from the audience guys still holding Bitcoin or Ethereum or any other digital assets while they continue their free fall? So there are some guys who continue to hold and believe in this exciting marketplace. So I'll gonna explain you very briefly here why I think the new cycle is just around the corner and why I think you should continue to hold and maybe even accumulate some more cryptos next couple months. So why regulation is important? First of all, because it is a railroad for institutional investors. And there is a big asset class called alternatives. It's everything besides just stocks, bonds, and real estate. Like anything besides traditional assets is called alternatives. And what's interesting about it, it continues to receive fund flows from all of the major institutional investors around the world for the main reason of low interest rates. In Japan, there is, for example, zero interest rate on a 10-year investment in government securities. In Europe, the rates are negative. Dollar rates were low for a considerable amount of time. So institutions continue to allocate capital. So if we look at this landscape of alternatives and the amount of capital that went to that marketplace and increased their value is significant. If you look, for example, at something like art, art is scarce and it is unique. So a global money supply of the 5 major central banks for the last 20 years correlated tremendously with the unique and scarce art. And this makes a very exciting case to invest in digital assets for institutions who have more and more capital to allocate because the interest rates are so low they cannot make the return they hunt for in traditional securities. Another thing about alternatives is they provide like much better yields, and global pension system in US, in UK is hungry for yields because it's underfunded. So if we look at traditional cycle of investments, particular asset class or a stock, it always had 3 cycles before public joined the marketplace. It had smart money like venture funds, seed, friends, family, and fools, how they call it, 3F law, joining the entrepreneur purchasing particular business. Then there was a phase of institutional investors joining the asset. Banks started giving loans, then investment banks joined and floated the asset on a stock exchange or somewhere where public could access it and invest in it. And then there was a usual cycle of retail bubble, and over the last 100 years, society witnessed a number of such bubbles. In Japan, there was a stock market bubble in the 90s. In 2000, there was a tech bubble in USA with tech stocks. But with crypto, we completely missed this institutional cycle, institutional allocation. And it is probably the reason there was this big retail bubble which is now deflating. Because retail investors are, in a sense, momentum traders. They buy just because it is rising in price. So if it rose in price yesterday, they buy today in the hope it will rise tomorrow. The same idea of selling, like people see the Bitcoin price falling and they just sell because they're afraid they'll lose their principal. So I really like you guys holding out there because you really believe in this asset class. But institutionals are important because they provide an anchor because they do valuation analysis, and at some particular price level, they become very interested in accumulating more of particular asset, and they provide a floor to a price. Now, with stablecoins, it's interesting because there's been a huge amount of announcements for the last year. People were witnessing this volatility in crypto market and saying blockchain is great, but crypto assets are bad because they don't have any use cases and they're volatile. So let's make a stablecoin which is algorithmic, or which is backed by crypto, or which is something else. And interestingly enough, they raised significant capital right when the Bitcoin price started correcting. So this is the funding attracted by biggest stablecoin projects, and you can see that right after price started correcting, a lot of stablecoin projects managed to persuade institutional investors to support them to develop their products, and the number is quite big. So almost $1 billion invested in the projects that are now being developed. The concentration is also big because stablecoins share winner-takes-all model, like Uber. There is not much of a sense having like 10 Ubers, right? You just need one app to provide you on-demand transportation services. So out of all that capital that went to the stablecoin projects, we still haven't seen any products yet. It's just 4 actual live stablecoin projects that are operating. But I think personally that majority of that capital will be wasted, but humanity will learn something, and it will develop the ecosystem of crypto-related assets and primarily regulation. So this is actually stablecoin transactions, and you can see it's only Ethereum-based stablecoins, but they're steadily growing for the whole period of this year. And there's also a Bitcoin chart on top of it, which just suggests that when the Bitcoin price was falling, there was a spike in stablecoin transactions. So now, about regulation. The problem with regulation is that it requires a combination of skills to understand the approach and the points that should classify different tokens and different crypto projects. Japan started this race last year, legalizing payment in Bitcoin. But China, for example, took really hostile approach and banned all cryptocurrency trading and ICOs, etc. So Singapore is one of the examples of a regulator who understands well this marketplace, and they actually were one of the first to support classification of tokens and applying application of different regulation that depends on different type of token. But it's interesting to see that countries who are crypto hostile have closed capital accounts. So in a sense, they are protecting their marketplace and their local currency from competition. And China is a perfect example in that case, because yuan is not a freely convertible foreign currency. There are other countries that take a wait-and-see approach, and that primarily because they don't have enough practice yet or enough science, like how to regulate this market. It's interesting that US, for example, which was at the forefront of investment markets regulation, they were the ones who invented the whole asset management space back in 1940 with the US Investment Act, and now US continues to take relatively conservative approach, trying to classify all digital assets either as a security or a commodity, or an e-money, which I will talk about a little bit later. Now, obviously there are types of market participants who do not require significant regulation. Usually regulators try to apply restrictions or monitoring on the gateways between crypto and fiat, because if you exchange some amount of money into crypto, you are free to transact within the whole world. You can move it out of the country, you can exchange it to other currency, you can purchase some Lambos with it somewhere, but definitely you can escape, for example, the IRS or other taxing agencies monitoring you or paying income tax. So this is the reason governments are closely monitoring exchanges. And it's really hard to establish an exchange these days and have to accept fiat, like dollars, euros, Singapore dollars. But historically, the regulation approach between different jurisdictions was very simple. If you're an institutional investor, if you are a qualified professional, you don't require a lot of regulation. Supposedly, you should understand what you are doing because you had a course in university, you had a practice in some financial intermediary, financial bank, whatever, and then you should understand what you are doing. But public typically does not understand the mechanics behind financial forces. So it should be the exchanges and some services that face public to be regulated. Now, stablecoins, it's still a question. Either it's a retail product or institutional product. Because what we discovered with our stablecoin, for example, with crypto euro, is that it is used by institutionals to enter and exit digital asset marketplace, because the balance sheet is very transparent of our issuer, because it is audited, and because they can reduce the risk. They store money on exchange to minutes instead of like weeks when they deposit fiat there. And I argue that stablecoins should not be classified neither in e-money nor a security, because in a sense, blockchain disrupts e-money. E-money regulation was invented 20 years ago when internet just came into existence, and e-money issuers were treated as a black box for the government, because e-money issuer, in a sense, took some fiat and then gave to a customer something that could be used to pay online. And then nobody really knew how much assets they store in a balance sheet. And even if government to audit it, the next minute it could be hacked or breached, and then it could print, a zillion of whatever e-money it is issuing. A good example of that is e-gold. There was a payment system called e-gold or Liberty Reserve before then, and they were shut down by US regulators for this simple reason. It is a black box. Nobody can understand how much real assets they store. But it's totally different with stablecoins, right? That are blockchain-based, that are public blockchain-based. Because with blockchain, you can have an on-demand verification of liabilities. You can check who holds and how much and where, and what is the total supply of this particular stablecoin. And Ethereum network right now is probably the most secure blockchain, public blockchain that is available. It's really hard to hijack a transaction or make a so-called 51% attack. And it's much more secure than traditional banking networks. We get messages every other month that one particular bank was hacked, and actually banks do not announce about their hacks, but believe me, they're happening every day. Some hacker from some university student or tries to attack a bank and try to steal a couple $1,000s here and there. Banks do not report that officially. Only in the year-end reports you can see like the total line security breaches amounted for whatever, like 10, 20 million for the year. And the reason for that is they do not want customers to know that their network is hackable. Now, Ethereum network may not be the best, and we're still here to wait and see what other blockchains will be there and how it will evolve itself. But for now, it's much better than any other existing payment network, security-wise. So stablecoins that are based on public blockchains on the liability side and have their assets frequently verified by typical and famous auditors like Pricewaterhouse or BDO, for to say, on a frequent basis, offer very safe product, and they could be, they should not be treated as an e-money, because in a sense they do not have this black box type of risk. And it's really strange that Europe currently is at its forefront of this regulation, because in US there are talks right now to classify all dollar-based stablecoins as commodities, and that will put them under supervision of CFTC, Commodities Trading Futures Regulator. And it will be basically a huge blow to the industry if that to happen. Because I can give you another example, like 100 years ago, people were riding horses, and there was a whole set of rules. How do you operate horse in a city? Because somebody had to clean manure after the horse. You should park your horse in an appropriate place, etc. And then cars started to hit the road, right? It was impossible to fit a car in the same legal framework as the horse. And I argue that stablecoins are the new cars for the old payment industry that is literally a horse. And it's interesting to see countries like Malta, for example, or Singapore taking a really innovative approach how they classify these instruments. So we at our company issued a book on digital asset regulation with this describing existing 13 jurisdictions as well as approach to classify tokens. We have a stand at the conference, but if you were to receive a book, please email to this address and we can mail you one. Unfortunately, we cannot share the electronic version, but we can send you a physical copy free of charge. Another way to experiment with proper stablecoin is to download our wallet. It is the wallet that allows you to transact on-chain with assets like Ethereum, Bitcoin, DAI, which is another stablecoin, and basically will be a stablecoin wallet for proper stablecoins that will continue to operate. Again, if you approach our stand, we are happy to share some crypto euro with you, and you'll be able to pay with them tonight in Renko bar for the drinks. And you can see for yourself how easy it is to use a regulated on-chain stablecoin. With that, our presentation is over, but I'm happy to take any questions from the audience.
Here you go. So that all of us can hear a question. Thank you. Oh, you can just throw it.
Throw it?
Yes.
Okay.
So, how do you do your due diligence on the stablecoins, and which ones are you going to add in the near future?
So the ones that I think, or my team thinks, are legal from the regulatory standpoint and secure enough. So some of the stablecoins are now experimenting with other blockchains, small blockchains. I think other blockchains still do not provide the level of security Ethereum blockchain provides. Stellar is probably the second best blockchain for stablecoins to experiment with, but others are nowhere close to the security. And since we have institutional investors who operate with this asset, we want to make sure the network is secure enough.
Can you hear me? No? I think you're wrecked it.
Try it again.
Okay, how's that? Okay, so my understanding of stablecoins is how I use stablecoins, which it's really a financial instrument for me. When I trade in and out of whatever tokens I'm trading. I park it in USDT or whatever stablecoin, and then when I go back in the token world, I get out of the stablecoin. But I can't see why you would use a stablecoin for like normal retail. Like why would I go to Starbucks and pay with a STASIS EURS or USDT? Because then I can just use normal fiat. Or if I'm a 100% crypto guy, I would just use 10 Satoshi to buy a loaf of bread instead of from my Bitcoin to a stable coin to a piece of bread.
Sure. So, okay, I think the question is like, how long does the stablecoin market have in the future? Maybe it's just a transitionary intermediary asset because, let's say, my children will be born and they already will operate in the environment where crypto exists, right? But to my parent, for example, I still have to explain what a crypto is. But now people are born with electricity and just take it for granted it works. So US dollar was depegged from gold unofficially for 40 years. And the whole world, you know, kind of was getting used to this fact. Maybe we'll have like 10, 20 years of a time frame to get this adoption of crypto, digital assets. And stablecoin is the easiest and the perfect tool, first, to play with and to experiment with the blockchain, and second, to push on regulation, to make sure regulators do not classify it as an e-money, but have us, entrepreneurs, experiment in a new sandboxes. The message is very simple. Let us experiment. Call it virtual financial asset. Call it like payment token, but do not call it security or e-money, because security is only for professionals, and e-money is disrupted by blockchain. That's it.
I see it as a financial instrument for us to experiment with it, but a lot of people see it as, oh, it's going to replace the Singapore dollar, the US dollar, or the yen, right? So
it will coexist, I think, yes.
All right, I'm afraid that's all the time we have. Thank you so much. Thank you very much, Gregory.
Thank you.
Round of applause for Gregory Klumov, please.